Ed. Ed, I was wondering if you... Ed, just wait to flip... Right, that's it. This'll get him. Ed, so glad you can stop a moment. Now, I'd love to have a chat with you about the wonderful world of shares. Oi! Where are you going? Think you know all about shares, do you? In that case, have some of this lovely pie I've made for you. Just as soon as you tell me all you know about shares, how they work, and why people invest in them. See, getting all grisly isn't going to help anyone, is it? So calm down and we'll start at the beginning. Right. Now, you may know that shares are also called stocks, equities, or securities, yes? Okay, let's take another step back. When a company wants to raise money for investment, it divides itself into many parts which it then sells to big investors and people like you and me. And a share is simply one of those divided up parts of the company. In other words, when you buy a share, you own part of that company. Maybe this pie can help explain things a little better. Now, if this pie were a company, the share would be the slice you're about to eat. You would then own part of the pie. I mean company. See, now we're getting somewhere, yes. Right. Let's say this pie represents a company worth £100, and let's say that the company's equity is divided up into 25 shares, then a share will cost you £4 each. Buying shares makes you a shareholder, and the number of shares you hold is a measure of how much of that company you own. Oi! Not so fast. You don't even know why companies want to sell shares, do you? Blimey, it's like pulling teeth with you sometimes, isn't it? There are many different kinds of shares for sale, but the most common is known as, rather appropriately, an ordinary share. The simple reason why companies want to sell shares is to raise money so they can invest in their businesses and help them grow. However, it's important to remember that shares are very volatile. They can and do go up and down in value for a number of reasons, many of which are outside of a company's control. You see, shares can rise in value if the company is predicted by investors to do well, but they may fall if the company's actual financial performance doesn't match those expectations. Other factors could be the general industry sector, political and economic conditions. It's a bit tricky, to be honest, and sometimes difficult to know where to invest your money and when to sell any shares you've bought. But don't panic. Before you buy shares, you'd be wise to do some research to learn more about this. You could look at investor websites, read annual reports, follow share price movements over time, and research the industry. And of course, you can always use a professional advisor to help you if you feel you need it. And I think you might need some help, Ed. So it may be tricky, but the great thing is by holding shares, you could be earning money if the company does well through dividends or capital growth. Yes, forgive me. A dividend is a payment made to you, the shareholder, and is a cash amount which the directors decide to pay its shareholders. While capital growth, on the other hand, is when a rise in the share price means your shareholding is worth more than you paid for it. Of course, there are risks involved. You never know about any particular company's share. But historically, shares in general have been a good long-term investment. And you can't argue with history, can you? Yes, well, quite. So, major shareholder, what are you going to do now? Wow, this guy really likes pie.